startups. One more of type Bangalore board members called Naganand actually partners with him. And he's also the co-founder of Hive, which is an incubation in the valley. Again, some of the smartest companies go there and get incubated. And he also runs, the fund over here. And David, what have you been your smart exits or some interesting?
I think it's still early. I mean, we've got a bunch of things in the US that happened. So there was a company called Deep Forest Media that sold to Rakuten in the US. And then there was a company called Koze, which very early, 6 months in, sold to Pinterest for stock at a very low valuation.
Okay.
And we just are contemplating what to do with that stock because Pinterest just listed, so we're sitting on a heavy profit.
Excellent.
And as we know, the Bay Area kind of has been very dynamic in terms of quick exits, early exits. I think India, we're still working on the portfolios, but some very exciting companies.
So, folks, the format for today is he's going to do a quick presentation on the whole funding cycle. And like Paraksha's program, we will make it more a discussion thing, where you guys can ask questions and participate among each other. So the answers need not necessarily come from Arihant. He might guide you indirectly, but your experiences will kind of add to his experience, and it's going to just enrich the whole the delta experience of this whole group over here. So over to you, Arihant, and
thank you.
If you need to ask a question, please raise your hand. And what he would like to also understand is a quick synopsis of what the audience in the room is, so that he kind of then tailors his presentation to you folks. So, quick question is: are you an entrepreneur? And one-line sentence on what your startup is. One line. So if you have mastered that one-line sentence, great. Otherwise, you'll have to come and do a workshop with us later.
Thank you. Thanks so much. I appreciate this opportunity, and I don't do this very often, so wanted to keep it rather informal and interactive. And thanks for the kind intro. Yes, I am a geek, completely been coding very early in life because we grew up, I grew up in a computer business all my life, which I'll talk about in a few minutes. And yes, I did get into statistics, financial engineering, realized that I love the modeling. I used to actually do it on paper in the US, and everyone used to think I'm crazy, but there would be stacks of paper where I would model the Black-Scholes model and all of that kind of stuff. And then I got into the PhD program, and my father said, you know what, you realize you're Marwadi, and if a Marwadi studies so much, they think there's something wrong with him. So please abandon all of this and come back home and join the business. And I did sort of do some of that, and it's been an incredible journey. So what I thought we would do today is I'll talk a little bit about our journey at Patni Computers as to set it as a backdrop for how do you kind of go ahead, build a business, write a business plan, seek out early stage funding, and once you have that, how do you kind of go forward and build the business or continue to build the business. I think that's relevant for the room. I mean, as Naveen said, how many entrepreneurs or early stage startups? Great. And how many are from the VC space or the angel investor space? Great. So, I mean, stop me if there are questions or if I'm going a little bit off topic or whatever it is. And yes.
It would be great if you could highlight what makes Patni family office one of the most successful ones in India. And of course, your other funds as well as a portfolio. What makes you particularly so successful?
Okay, sure. And I think, so I'll take that a little bit later. I mean, I appreciate the question. Let's go with the flow and then I'll kind of build that in. Any other questions right now? So let's get going. And I think if someone can help with a time check, because as I said, I don't do this very often, so I can ramble, right? So let's keep it, I want to police myself a little bit. So I think as I mentioned, my family was one of the first, computer businesses in the country in the 70s. And I count myself as very fortunate to be able to go through the journey of inception, execution and exit of a business over a period of 30, 40 years that created immense value, not just for us but also in the ecosystem. And I'm very proud and humbled by the fact that my family started this in the 70s and sort of grew it, and we participated in it. So it's been an incredible journey and taught me a lot of things in terms of how do you sort of look at new business ventures and how do you build businesses, and I thought I'd share some of them. So we're still on this slide, don't worry. So I think very quickly, and we started, how did the idea come around, right? So my uncle had gone to MIT for his master's, and he was trying to, and we had nothing at that point. I mean, we were sort of, based up in Rajasthan and UP, and had just come down and we were trying to create something for ourselves. And the business opportunity at that time was very simple. It was conversion of data. So we actually took hard data from the US, shipped it here, put it on magnetic tapes, and sent it back. In fact, the company initially was called Data Conversion. It was not called PCS or Patni Computers. And I think you're smiling. I think you probably know that, from back in the day. And then from there, it led on to many other things. I think the hardware boom came up. We started bringing in mainframe systems into the country, installing them, maintaining them. Then, of course, personal computing, network and infrastructure management grew the hardware business substantially. And I think that was what the cash cow was in the 80s. There was nothing like software in the 80s, so to speak, right? I mean, it was there. We had the software division, but it wasn't sort of the one that was creating wealth. And then in the early 90s, the then finance ministry kind of opened up the trade barriers. And as many of you in this room may know, hardware just kind of went completely commodity. The margins were absolutely taken away. It became more of a network services business rather than an actual hardware business. And that's where luckily the software focus started picking up. And I don't know how many are old enough to know the Y2K bubble that was there. I mean, I was actually working on projects for the Y2K, and that created a lot of momentum. And we were fortunate being at the right place at the right time to have been able to build a very sustainable business. And there were very interesting things. So first of all, our competitors were younger, Infosys being one of them. And Infosys, in fact, went public in the mid-90s. Wipro had also gained a lot of momentum, and Tata's TCS also was one of the earliest ones along with us that had started growing. And for us as a family business, it was, we were contemplating, should we go public, should we raise money? The group could converge on a thesis, so we kind of sort of just stayed our pace and reinvested into the business and grew. And that did create an aura that we were a family business, which we were at that time, because most of the business, all of it was owned by the family. Whereas our competitors were, giving stock options and all of that kind of stuff. So attracting talent, representing to clients, all started, we started getting some roadblocks there. So at that point, what happened in about 2000 is General Electric, which was our largest customer, decided to invest in the business. And then we got General Atlantic Partners, which is a Connecticut-based private equity company, to put in a substantial check. At that time, it was about 100 million. Today, 100 million is what probably Oyo spends in a day, or maybe a day and a half. But not to get away from the subject, I think at that time it was a big tech funding, and that really changed the entire trajectory of our business. So it was about, how do you professionalize it? How do you, take out the family aspect and get it more systematized, so you're able to attract the best talent. You're able to represent, global aspirations to your global clients, and so on and so forth. After that, we went public, and we had a sort of a management change, and then finally we sold the business in 2011 which, to be honest, was a very emotional, kind of moment, because especially when you have the same last name as your business, it's never easy to part ways. But it was the right thing to do at that time, and that has enabled me to do what I'm doing today. And to your point, sir, about Patni Family Office, I think at that time we realized that we still had the technology and the entrepreneurship aspirations, but we may not have the best ideas because the world was changing. 2011 was just when, Flipkart was not even Flipkart, and e-commerce was kind of, starting off. So what we thought is, let's try and back, successful entrepreneurs, many of them that are in this room, that have the ideas and the vision, back them with not just capital, but also, our actual sort of time and strategic resources to be able to help and build a business, right? And rather than doing it from our prop book, because it's very easy then to, one, get a little bit swayed by everything that's happening and not being able to really add value, we thought, let's create domain-centric silos where we can invest with discipline and therefore add value with discipline. So our first fund is Nirvana Ventures, which is in the consumer internet space. We thought that this is the opportunity area. This is back in 2011, where China, having grown so much in e-commerce, and with the smartphones coming in and the internet penetration, this is an old story at this point. It made sense to get in there. So we set up that fund. We partnered with Rajan Mehra, who ran eBay in India earlier and was with Clearstone Venture Partners. So he knew the domain. He knew what were the levers that made a successful business. We came from a very cash flow investing services model, right? And the internet domain was a totally different one from our DNA perspective. We went on to set up a big data incubator called The Hive, which is parented in Palo Alto. And The Hive focuses on big data companies, or companies that are building data-driven applications to help enterprises solve problems. And again, this was 2013. So today, thanks to Reliance and Mukesh Ambani, data is everywhere, right? And that's being talked about. But at that time, it was still a new concept. So we set up that fund, and in India, I ran it, invested in companies which are doing well, and we're sort of growing them. And then the final one, because we thought that enterprise had a lot of room to grow, with e-commerce and internet having had its run. Enterprise innovation in India was had started showing signs of growth early, but a lot of technologists that moved from the Bay Area to Bangalore, perhaps, were building, really innovative enterprise products. So we got together with Mohandas Pai in Bangalore, with Naganand, and co-created this fund called Idea Spring, which invests in early stage enterprise tech companies. And we have a portfolio of about 10 companies, and I'm happy to talk through it, but some really nice, different innovation, things that one wouldn't ordinarily see perhaps being funded. So I spent way too much time on that one, but I think if we just go to the next slide, I think very quickly the reason this story was relevant to me was, I think what it taught me is, let's not focus on now creating valuation uptakes and how do you raise the next round of funding, but when one comes thinks about building a business, it's about creating value, right? And how do you create a sustainable business model that can stand by itself, even if there is less funding or if the market turns or what have you. And I think the few lessons that we learned was, to kind of hunker down and build business, but to take capital at the right time from the right people. Because when we did that, not only did we avoid dilution, but we also made sure that the capital that we brought in added a lot of value and helped the business grow. I think the good thing today is that entrepreneurs don't have to wait 30 years to see $1 billion kind of outcome. And clearly, over the past few years, there are many companies that have done this in 4, 5, 7 years, as is shown on this chart. The bad part about this is, young entrepreneurs today are living in a very fast-moving, dynamic environment. They don't have time, like 30 years, to try and fail and try again. They still have to do that. Every entrepreneur has to do that, but you have to be really fast. You have to learn from your mistakes quickly, move along to the next endeavor. Also pivot when you have to. So everything's a lot more fast-moving. And we do not have the luxury of time today because somebody else will take over, and I think that's, if anything, that's the key thing from this slide is, let's not waste time. Time is an opportunity cost that most of us don't factor in because we feel it's something that we have, but we actually don't, right? So when it comes to building a business, I thought I have, through all my professor contacts and things, I'm happy to share lists of books for writing a business plan. But that's not something I excel in. I thought I would just cover a little bit about the main facets of how to think about starting a new business. And I just want to know, is this relevant or should we just skip to the funding thing?
Relevant.
Is it? So I'll quickly run through the way I look at it when even I sit and evaluate, right, a bunch of folks. So obviously the first thing is the market size and competitiveness. And I would just like to call out a few things. It's important for the team to recognize where the levers are toward making this business successful, right? So if you think about AR, VR, right, augmented reality, a lot of the innovation, a lot of the end use, a lot of the talent is out there in the Bay Area or perhaps Eastern Europe or wherever it is. It's not really here in India, and I know this because we have an AR, VR company. So then it becomes very critical for us to be able to either have access to that, or as one of my companies did, Hudat, one of the founders have to be based in the Bay Area. To try and solve that sitting here in India where everything meaningful is happening 2 oceans away is just not practical. And to my point about speed earlier on, by the time we sitting here get to it, it'll already be too late. So you kind of have to recognize that as a very critical feature of that market. Similarly, if you're trying to start up in the e-commerce space, I think that's a very important. It's very important to know what the differentiation is because it's crowded, it's capital intensive. So even though it might be a very big market and not very specialized, we need to know where we stand in terms of differentiation. And when we look at the market size and competitiveness, right? And I think you can always say, and I cite Patanjali as an example, but you can always say, look, I'm going to come out with the next kind of shoe or the next kind of any other consumer product. But really, what are the levers that help us differentiate? And I think one has to be honest, right? I mean, you have to be foolishly optimistic as an entrepreneur, but also kind of brutally honest that am I really that different, or is it just something that I want to do? And I think that's a question that one has to ask early on. To Naveen's point earlier, one can build a lifestyle business. You can say that, look, I'm going to create a kind of shoe, as an example, that is high quality, that's super comfortable, but I recognize that this is not going to be a very large scale business. So I will try and bootstrap it, get small amounts of money and run it because I'm passionate about it. But if you are going out and trying to, raise capital and build it up, then you have to be kind of very, very critical about whether there is a real differentiation or not. I think here, research everything as much as possible. Talk to people. There's no question that we have so much data today, which we didn't 10 years ago, right? About how these kind of businesses, different kind of businesses operate. So I think it's great to be able to learn from that. And as we kind of build the business plan, I think one can't emphasize the team aspect enough, right? Again, very quickly, in the previous slide, we talked about market competitiveness and attractiveness, and we talked about identifying what the competitive edges and what the levers are. If one were putting a team together, I would try and map that. So I would try and create a team that has control of those levers to be able to differentiate and break out. So for example, let's say we're building a blockchain business, right? You need someone that knows the technology around blockchain, and you need someone that knows the domain around blockchain and the applications, whether it is in the financial services space or it's in healthcare or what have you. I think that if you're a single founder that's just trying to build a business around something that seems cool, it's going to be very difficult without having the right talent on board. For early stage businesses, having co-founders, even if the equity is not equally split, is very powerful, because again, hiring people and retaining them is a challenge. So having those as co-founders makes a big difference and makes it much easier to get funding. I personally like teams that have 3 co-founders or 2 co-founders. There's a little bit of redundancy, there's a little bit of risk adjustment. I don't like it if they're 4 or 5, because then the risk becomes, are they going to get along, are they going to break away, and that's happened in many cases. Single founder teams, although we have done it, there is always that thought, right, that it is going to be run as a kind of a dictatorship business, and then you are laying a lot of trust and faith in the founder. The other bit is that when you look at the sources of competitive advantage, so you build in the market, you build in the team. Again, very, very important to ensure that the competitive advantage you have is relevant to your industry and to the geography. It is, if one is building an e-commerce company and has someone from the US come here and build it, there is value, but the real value is if someone knows how that's done on the ground here, because there are differences in these businesses across geographies. I think we can move on. And I'm going to quickly, this is the key part, right, the capital journey, and I may shout from rooftops saying that don't think about capital and build a valuable business and think about value, but all of that needs capital. So to be quite honest, it's very important today to know the capital journey. And we have data again of the past 10 years. So what I mean by capital journey is how much data, how much money do you need, when do you need it, and what are the metrics and milestones you will achieve with that money. This represents a certain maturity within the team. It helps your early investors, your later investors recognize that you realize what's at stake. So we can't be foolish enough today and say, look, we're going to build a world-class e-commerce business with $1 million. Everyone knows that's not going to happen, right? Because it's just become a capital-intensive game. So I think now use the research to figure out what kind of capital your business needs and when it needs it. I think we can go in the next. And this is just a representation of Flipkart's journey. I think we all kind of know this, and I don't think the founders of Flipkart maybe back in 07 or whatever really thought this through, because they were early movers. But today we can learn from this. So if we're trying to play in a space like Flipkart, so for example, going back to my shoe company and saying, okay, we're going to sell shoes online, we can learn through some of these things. So we know what the cost of client acquisition is, we know what the cost of warehousing or fulfillment is. These are things now that are solved, and there are people out there that know this. So I don't think that it's excusable now not to know it and go in blind, right? I think it's important to know it from a 5 or 10 years basis. I think I said that. So coming back to raising capital, right? And I think a lot of folks know this. So I think I'll just briefly touch on it. These are, I tried to map out the various kinds of rounds. So family and friends, angels, seed, early growth, private equity. And in the next slide, we'll see the tentative, I think we can, the tentative check sizes and time frames. And although I've done this very broadly, right, this becomes very specific to your business. But if we can just go back, please. I think that just to touch quickly, friends and family, early stage business, believers in you rather than the business. And that's kind of apparent because the end of the day, they don't know how the business will go, but they know that this guy is not gonna, let me down. I think it's great between family and friends and angel if you can get some kind of an advisor that is from this space that will add credibility to the company. So, sometimes a lot of people say, like my friend Ravi Gururaj in Bangalore, he's a serial entrepreneur. He had this idea which was quite capital intensive, setting up fulfillment lockers for e-commerce deliveries. Of course, he had great pedigree. He went out there and he raised a ton of money from Axel Partners before even starting the business. Mukesh Bansal did that with CureFit. But a lot of people say, look, if you don't have that pedigree and you don't have that that serial entrepreneurship background, how do you get money for a business? And one way of doing it is to get the right people around you in terms of advisors, believers, and strategic angels that can sort of be your spokespeople. And it's the earlier the better. So whether it is giving them some sweat equity or giving them any kind of economic advantage, if you get the right person, then do it, because it does make a big difference. The seed round is your first institutional round that comes in. Again, important from the standpoint of who it is, what the domain is of that particular fund. Again, coming back to us, we do all seed funds. So IdeaSpring, as I said, is enterprise tech. It's early stage enterprise innovation. So companies such as that come to us because we can add value. If a company in e-commerce comes to us, we're not going to be able to do it. So in seed stage, depending on what your business is, try and identify funds that do play in that area, because it does make a difference and they are going to be able to add disproportionate value. Again, sort of Series A can be from seed to Series A, there's sort of a little bit of overlap. And then you have your later stage where I think that universe is fairly large, but again, in terms of differentiating the business, and there are certain funds that will do certain kind of businesses versus others. So we can cross. So here, I think most folks know this, right? In terms of how a fund is structured. I don't need to go through this again. I just a few quick takeaways for people that are out there and talking. Funds, and this is just me being a fund as well as me seeing what's happening. So funds love talking to companies. The KRA of the analyst is to get you on their radar, right? And to fill you in that Excel row. Because they need to go out and meet and talk to as many companies as possible. That does not mean that they're interested in funding your business. And I think I meet a lot of entrepreneurs and kids that say, Sequoia se call aaya, so they are really interested in our business. That's not true. It's not that they are not interested. It's just that they are collecting data of all the companies that are out there. So that said, it's what you don't have to be fooled that they are going to be investing in the business, but it's not a bad idea to engage with those analysts and to kind of keep them warm. I think when you're ready to go out and pitch to that fund, they can help you do that. Especially analysts where you have some kind of connection and overlap, right? Either they went to the same college or they were from a same previous organization. It really helps to have a friend like that out there in any of the VC community, because this won't be like said out aloud, but at the end of the day, familiarity builds confidence, right? So today when you're talking to an analyst at a VC fund for a year, while you're building the business, and then you go pitch, they already know you. They know you, they know your integrity, they know your value system. So it becomes a lot easier for them to then push it forward. Do we need more chairs? Or?
No, I understand. Over.
No, I think we can get it from outside.
Please continue, I'm sorry.
Are you sure?
Yeah.
The other thing is, as we're raising capital, know the fund's portfolio. What kind of companies they invest in, what kind of check sizes they write, because that is very relevant. And there's no point wasting time with a fund that's just not going to be interested in your kind of business. Also, knowing the life cycle is important. So most funds are 7, 9, 10-year life cycles, and typically early on in the fund life cycle, people will take more riskier bets, more long-term bets, because they have time to play it out. When you're looking at a fund in its last stage that is so early stage that will take 10 years to build up, unless of course they have a follow-on fund ready. But it's unlikely, right? They'll probably do it straight from that follow-on. So I think again, from that point of view, it's important to know where they are in their investing cycle. I think that while picking funds, I would also, we can move to the next slide actually. I think yeah. So a little bit about picking funds. When I say deep pockets, again I use this example of enterprise versus e-commerce. If you need continual money, then going to a small, very early seed fund as an e-commerce company might be tricky because they may not be able to keep backing you with capital. Then you may want to go with someone that has deeper pockets. For sector expertise, like for example, Idea Spring and early stage enterprise, that's when you want to go with a fund that and disregard the amount of capital that they have, but more about the expertise that they bring to the table. I'll quickly cite an example here which I love, and Idea Spring being a deep tech fund, I mentioned to you we had some interesting companies. So one example is that we found this IISc professor who had built a application, a software simulation application to measure electromagnetic interference across sensors, right? And so think about self-driving cars, and think about all the different sensors there and how those magnetic fields interfere with each other. And if something goes wrong, it's almost a life-threatening thing, right? I mean, you can sort of kill someone. This is a problem that's unsolved. They actually teamed up with Bosch, and Bosch helped them build the application, and then they didn't know what to do with it. So we kind of met them, worked with them, and arranged a round where Idea Spring came in with the PhD IISc prof who was running the business, and IISc and Bosch, to create really like a academia meets corporate venture meets early stage venture kind of cap table. And it took us about 1.5 years to do this because Bosch doesn't move quickly, IISc doesn't move quickly, and we had to solve for a lot of different things. But the company is doing really well now, and it's super exciting. So that is something which a larger fund probably is not going to spend too much time doing, right? Because this is a small round, a lot of effort involved. But because this is our domain, it made sense for us to do it. We can move. And I talked a little bit about this market access. We got a lot of help, for example, from General Atlantic Partners, where when they put money into Patni, they really opened up a lot of new market opportunities for us because they were based there in the US. They had a lot of inroads in large corporations that became our clients. I talked about fund strategy and life cycle. And I think, of course, intangibles, which I touched upon earlier, right? Especially in early stage, you have to have a believer. I mean, if you have someone who's a critic from day one, you probably don't want their money. It's not, it's not a very productive exercise because you're always going to be on the defensive foot. So I think if you find investors that you feel a certain connection to, that's not a bad parameter to take their money. So very quickly, I'm not going to spend time on this, but debt, equity, the different structures, make sure you understand them, understand the positives and negatives of, even in terms of the different kind of notes, CCDs, OCPS, OCD, I mean, there are technicalities there. So once we work through the entire, business plan and who do you want to go after and all of that, at least keep this in mind. Next, please. Yeah, and this is really important according to me, because I talk about this a lot with my companies, that it takes 6 months to get money in the bank. And I won't repeat everything on there, but you have your pitches, your discussions. A fund will have an investment committee. The investment committee will approve. They will send you a term sheet. You will work through the term sheet, sign it. Then there are definitive documents. Then there's due diligence. I mean, there are a lot of hoops to jump through when it comes to institutional funding. So once your sort of angel friends and family and all this stuff, it's very important to keep in mind that it is not a trivial process to get a seed, even seed funding in, unfortunately takes a long time. So the fundraising process, working with many parties, and again I talk to a lot of my entrepreneurs about this. I would get bankers, lawyers that understand your business, the size of your business, and what you're trying to achieve. A lot of the early stage work we started, working with Nishit Desai, and I work with a lawyer there who's absolutely fantastic, Karan Kalra, who understands what early stage investing is, right back from 2011, 2012, because otherwise if you try and use the same framework as you do for a large round, you're over complicating things, you're over solving for things, right? So I think get the right partners, get the ones that understand what you're going through, that understand what you should give up and what you should not give up. Go to the next one. So for example, all of this can be touchy points, and I've seen a lot of deals that don't go through because someone stands their ground on affirmative rights or board representation or something or the other, which an entrepreneur doesn't even really fully understand, and then they have someone that's kind of egging them on in the wrong direction. That said, also ensure that when you're talking about these things from the funding side, your investor is somewhat entrepreneur friendly, because again, in an early stage business, if you become very heavy on some of these, you're really killing the entire aspiration. And I think we can go on. So as I said, we talked about a little bit about the business building journey, about how do you go out and get early stages of capital, about how do you close the round. One thing I didn't mention about early stages of capital is I think it's great to have some strategic folks as well. So now in India there are a lot of corporate venture arms, and if that makes a difference to your business, I think that's a valuable name on the cap table. Finally, when it comes to post-closing and best practices, and this is something, these are just 2 slides, but I think the most most overlooked is that when it comes to building relationship with your investors, reporting, MIS, adding people to the board, we kind of fall short. There's always one independent board seat generally in documentation which never gets filled. And I've also made that mistake and continue to. But I've seen in the US and in the Bay Area that this board seat is filled from day one. And the kind of difference that a relevant independent board director makes to the trajectory of a company, especially in early days, is immense, right? So I know companies in the Bay Area that get ex-Cisco people on the board because they are in the enterprise and networking space, and you get to learn so much from mistakes that Cisco made early on, right? So I think there's just a wealth of information and guidance that comes on, which we don't recognize here as valuable. We think the board is somewhat just a company law kind of check the box. A lot of people will do paper board meetings, to be honest. A lot of people won't really pay attention to the value of the board. I think it's really important to treat the board as your sort of the biggest asset that you have. Get the right people on there, the people that are there, even the investor representatives, assign them roles and tasks and actually, things that they need to do for you, because that's what everyone says that they will do and then no one ends up doing it, right? But make them accountable for being on the board. Have real board meetings with real issues. Send out the MIS that you promised to send out. So if you think that the MIS that you promised on paper is too impractical, just call it out and say, look, I'm going to send this, but then do it, right? It helps you also police your own environment, and it helps you then step back and think about where you are in the business. Otherwise, it's so easy for a team to just, kind of get so absorbed in what they're doing day to day that they can't step back. So board meetings are a great environment to do that. And if you look at the next one, it also helps build corporate governance, right? So the one thing I'll say is that it's very important to have paperwork and your finances and everything in order from day one, even if it's a small business. With, all your tax filings, all your compliances, because the moment you go out for institutional funding, they are going to expect all of that done. And that's one thing that an institutional investor cannot overlook, is compliances and all of those things. So no matter who you are or what you are, if you don't have that in place, your round will be delayed until it is. And especially for fast-growing businesses in that growth stage, because early stage it's still easier, you don't have that much data to deal with. But growth stage businesses that are running fast, that have daily data in terms of numbers, for them sometimes to get it all in order takes a while. And they need the money ASAP, right? So then that becomes very tricky. And then they go out and ask for a bridge or a pre-closing round or whatever it is. I think the better governance we have from day one, the better it is, and having all of your documentation in place is really important. So I would hire a finance person as soon as you can afford it, and as soon as and not wait for the business to get to a certain level. I think that's a mistake that we all make, right? I mean, in that sense. I think I've talked about all of the qualified board of directors, defined roles and responsibilities. I think the last bit I will say, and then open it up for discussion, is I've learned, and the hard way and the right way, that frugality is really, really important. And it's easy to be frugal initially and then start spending rather than vice versa. And there are a lot of companies that we know that started spending a lot of money and then had to cut down the spending, and then that becomes a very uncomfortable situation. I think depending on the kind of business that you're in, you have to spend money obviously, but to do it with the right kind of vision from day one, and not build very splurge kind of practices within the company, whether it's expenses or it's even salaries or whatever it is, goes a long way. It's very hard to dial back that company culture once you've set it in play. You never know when you get into a money situation where you have to start conserving capital. So we've done that at Patni. We had nothing to start with, so we had no choice. But being frugal and really looking at what's in your wallet has helped us in that journey for sure. So thanks guys. I'm sorry if it was a little bit all over the place, but wanted to cover all the points. And happy to open it up for questions, not just for me, but I think there's a lot of expertise in the room that's probably a lot better than me in a lot of areas. So please, let's just get into a whole discussion and a cross-table discussion.
Yeah, I'm a builder of IoT products into way of surveillance, security, and environment security. The recent case I want to share, like 1 week ago, Indian Railway has released the announcement about they will release tender for $500 million for largest CCTV surveillance. So we plan to build the international associate and also subject specialists. Along with, I believe that we should also involve Indian like wealth management actually. So when international investment also come in that project actually. So now we are discussing with Google, MediaTek, other people who are part of this project, because we have built up hardware. India first national surveillance platform. Also we planning to approach Niti Aayog actually. So how this kind of wealth advisor actually, who they have money also there along with international money, so they can take care about wealth side. Everyone's wealth should be created. Like I am something to look after support of the product and project side actually. So same time also we have to cover. So what kind of your strategy on this area actually. So along with the project way, example you take an example like Bollywood movie actually. You make a star with a movie. So after movie finish 2-3 months, then you can sell the rights. So such kind of project where we can all stakeholders to bring together actually.
No, and I so from what I understand you're saying, and I think there's a great strength in consortiums.
Okay.
That's what you're hinting at, right? And especially in the US, you have government and academic build a lot of common projects together. So Google will tie up with the US government, well not recently, but in early days, or MIT will, and then you will have kind of what we call there as patrons.
Okay.
So deep pockets that will come and kind of fund these projects. It would be a Elon Musk equivalent, or Bill Gates or whatever it is. I don't think we have that right now in India, right? I mean, I think the biggest government project, if I may say, in association with tech, is the Aadhaar project, right? That Nandan did, and that's something that was quite a big mammoth
So same planning, we are planning to create the national surveillance platform actually,
Yes,
you know.
I
So
understand.
and currently no tech people has such kind of expertise on this building
Correct.
actually. So but same times there is a technology, same time also financial. Currently
There is.
currently, you know, government assigns their own fund, but they don't think about using such kind of IoT, AI-based technology where they think about CCTV, but we think about how other things are. 80,000 children are missing. Where you put such out, you know, cloud-based surveillance things, so they can also solve other problems together.
Yeah,
actually.
yeah.
You know.
So I don't have an answer how you fund that, right? But I think, I don't know if anyone else in the room has a thought, but I think again, getting the right people involved and you know, the government is what it is, but there's a lot of initiative on that part, and if you ask me specifically around a wealth manager, it's difficult because there is no near-term payback on this one, right? So it's more about, again, working with folks like the IFC and the World Bank and some of that to see whether they can evangelize the project, or someone from the government. I don't see any other.
These are largely products. There are also other smart cities project which is the
Yeah.
size of 50 crore, 100 crore
Yeah.
actually. So and sometimes they're looking for the service model instead of capex model
Yeah.
actually. So such kind of smaller project, such kind of an advisor that they are come on the board actually. You know.
Sure.
My name is Anand. I'm still bootstrap and B2B fintech for the energy commodities value chain. So, already in the stage, the cycle
Sure.
is good. But how in India, how independent are the advisors or the board members? And I'm not saying something will come to a clash, but where are the loyalties? Are they brought in by the venture capital guys or?
So you can have an independent before funding or after. I think what I mentioned is if before funding, if there's a strategic advisor from the space, bring them on as an independent director. If one doesn't, then there's a funding round coming in. Typically, let's say there are two founders, so there will be 2 board seats, and there may be 2 board seats for the fund, and 1 board seat will be for an independent, very simplistically put. So the independent is a joint decision, and I think what people in the valley do, if they don't know people from the network, and especially slightly in later stage and growth stage businesses, you actually hire agencies to find you independents, and it's a role defined kind of position, right? Saying that, okay, you're going to be an independent director for a couple of years, and this is what we expect you to bring to the table. You can't rotate independent directors in 6 months, but you can certainly do it in 2 years or 3 years. Does that answer your question? Because independence should really be independent.
Exactly.
And the discovery of them is a joint decision. But, and that sense, it's the person, right? I mean, the fund may identify a person, and you may think that if they've got them, they're going to be on their side, but it's really...
No, I'm not saying I want to fight with my funders.
Yeah, no. I'm just saying the...
Better be paranoid now than
Yeah, so I think it's a joint discussion, and I would obviously spend time with that independent director before getting them on the board. Because once you get them on the board, it's not like, as I said, it's not trivial. You can't then take them out 3 days later. It doesn't work. You know, it's a very bad signal, and it doesn't work with ROC and all of that.
Do you mind if I another question? Again, paranoia, it's not happening at the moment. But is it worth getting the specific incorporation articles maybe, or make them general and later on keep on modifying them if you are getting funding in the new?
Yeah, that's fine. I think that's a very sort of company secretarial thing.
Yeah.
And
I can't afford one.
so I think it's good to be general. Typically what companies do, they include every single thing in the AOA. There's certain things that you can't include because that flags off certain matters at ROC. So I think, for example, financial services is one thing that, you know, will question because there are regulations around certain things, right? But otherwise, in general, you can put the whole bucket list there and then, you know, figure out what to do later.
Kickers or triggers.
Yeah, I think I wouldn't, you know, that early documentation from a company law perspective, I wouldn't, you know, stress about.
So, that's it.
Yes.
Hi there. I'm in international advisory area, so I help international companies come to India and vice versa, take Indian companies outside. I know a lot of investors from UK trying to invest into India, especially in the fintech and tech space. Usually what happens is there's a deck and then the presentation goes and the investor likes and then they get onto the phone. The problem that I'm facing is most of the Indian tech goes straight into the product and features of their product rather than speaking about the business model, the revenue, the business itself, which is a very big disconnect from the international advisors. Usually after that half an hour call or 45 minutes call, things don't work out. And I've tried to communicate that a lot. So I just wanted to know your thoughts. How do you communicate, communicate that to an entrepreneur, saying that when you're talking to an investor, it's more important to talk about the business and now how innovative your product is, which may be true. So just wanted your thoughts on that.
You know, that's a really relevant point, and it's something I talk about as well, and it's something we should organize as a workshop because, you know, I've traveled out to Europe and I've seen companies from Brazil and, you know, all of that. And me included, I think our culture is not well tuned for storytelling. And similarly, like I think I could have done a much better job, you know, being self-critical, kind of running through this than I probably did, because you focus so much more on the content and as to your point about the product and the technology, and not enough about how you're conveying it to the other side, what the business implication or what the actual model is. It's not something that we solved overnight. I've also come against it, but especially if the company that you're advising, I think it's important to do a dry run with them a couple of times and to kind of push it that they need to speak a more human tongue rather than the, you know, the Star Wars lingo, so to speak, when they're talking about technology and product, because the audience that they're addressing need to get some different takeaways from it. But definitely there is, you know, we need to learn a lot more about how to spin a story from the West. I mean, we don't do it well enough.
I want to add that because you know, maybe possible like if founder should not be present to the investor. Maybe they hire some outsourced person actually who are not so much emotional, because I see about like sometimes, you know, they are so much logically deeply associated with the product development actually. Sometimes they don't think about. So person who understand either if they are not a co-founder, such kind of, you know, business development side, so they can hire any outsourced person actually as agency actually who can present with the investor actually. That's also can work out actually. Otherwise, you know, this is 80% time they are spending on technology development, then their minds are completely going on tech side. So this I think the solution
but
is
this is a problem, and you know, NASSCOM did this, right? They take companies there and they put them through a very intensive camp that talks about how do you do this. Naveen asked earlier, 1 minute, can you tell, or 1 sentence, can you tell your story, or in 3 minutes? And I think these are very important areas, even for tech founders to kind of now, you know, get up to speed with, because you know, we are at the end of the day, you know, trying to sell our business to an investor, right? And you know, you need to know how to do that. So,
Jewel from Software Technologies. So, in the current budget, because of the higher tax structure, a lot of investors are going out of India. That's evident in the stock market also. What is your take on the foreign VCs and PEs, the current scenario?
I think there's a lot of interest in India. You know, I just came back from a long trip to the US, and there's a lot of liquidity in the US, and everyone is looking at India as you know, a place to invest. So you know, clearly, like early stage in India is a little bit still a question mark, because there's just not enough rapid advancement. But if you look at the growth stage, the slightly later stage companies, a lot of people are excited about money. In fact, just today there was an article about how some of the early firms are getting exits from you know, companies like Oyo and others. So for example, Lightspeed is getting an exit because a bigger investor is coming in. So I think that this right now, this certain lull is cyclical, right? Obviously, people are a little annoyed about the FPI law or whatever it is, but the genuine interest with the confidence in our economy, in our government, in our growth rates, in our demographic, in all of that doesn't change. So I wouldn't be too worried about that. again, there I would say it's more about creating value and creating a valuable business, not about what the market is looking at.
Yeah, so my name is Akash. I run a early stage venture. It's in the space of mobility. So one problem that we are facing is when we're meeting investors, when the terms are being discussed, etc. We don't know whether it would be the right time, and do we have the resources to invest in a person or an entity who would look after things beyond it. As a founder, I'm looking at, which is purely equity and some basic terms as in how much are we raising, etc. And are we being protected and we're not being taken for a ride. Obviously on the face value everything does look normal, but there are things that we are told or forewarned about by people that do take care of this, but these are far and few advices which we can't really connect the dots. So should there be an investment and effort going in having someone audit this for the startup?
Yeah, I think, and this is not a very large expense, right? I think if I hear you right, getting somebody, identifying a person that's able to help you understand a lot of these dimensions in terms of the paperwork and the rights, and to also look at whether your company is stacked up right for investment coming in. I think it's good, and it could be it could be a friendly neighborhood CA also or something like that, but someone that I think you have to start with someone that understands your vision and what you want to do. So getting someone who's too paranoid, who's too stickler is also not good, because you have to give some things away, to get things in the door. So I think that's almost like a personal equation that you have to build.
So second part to that question would be, if that amount, whatever, or resource that is going out, if that is built to the company, the whole point of raising money is that the company is going through.
Yeah, it is. It's not easy. Yeah.
So can that be conveyed to the investor that this is where I am also investing in, or that this also will be a part of something? Are investors okay listening to this bit of caution that we are taking from our end?
So what happens is that let's say there is someone coming in with a round of capital, then in the term sheet itself there will be a clause that says that the costs associated with closing this round will be borne by the company post-funding. And you typically put a cap number there, because this is also the investor's cost, by the way. So let's say you put a cost of 1 lakh, 2 lakh, 3 lakh, I don't know, whatever it is, or 5, in larger rounds it's larger, where you say, okay, this is the kitty we will use. So agar 3 crores come into your company, let's say, then that 3 lakhs is going to be used to pay your expenses for closing the round and the investor's expenses for doing the paperwork.
So can I just add to what you're saying? I meet a lot of entrepreneurs who actually don't calibrate or take into account the zero salary that they've been taking for over 7-8 months. And I always advise these entrepreneurs, work that into your equity model also. Because it's not zero salary, it's that salary which you've actually foregone. So work that into the equity model. Because a lot of investors will come and kind of say, you can't take this amount of salary yourself, but this is an acceptable startup founder kind of a salary and things like that. But negotiate on the other side saying, listen, I'll do that, but can I get this X percentage equity non-diluted and this part of it coming back as a flow back to me or something like that. So you can work on it.
There is a clawback based on performance of the business. So that's also a common practice now.
So,
yes,
I'm sorry. You can
go ahead.
So I have been a VC analyst for over a decade. But whichever business, business school also we were taught that look at cash flows and that is how you run business. And even today, I'm scared if I see a business model with perpetual negative unit economics.
Yeah.
But and I see capital disrupting the VC market rather than innovation disrupting it. So where do we stop?
I think that's a common fear, right? And it is industry specific. I think we had one blowout when Snapdeal kind of fell and a bunch of others, which a few years ago. After that, there I saw, even within e-commerce companies, a slight sense of a slight sensibility coming in terms of unit economics. So before that, even the funds or entrepreneurs didn't talk about fast-moving market that if you don't get, like, so for example, the shoe example, right? If they want to really grow, they have to plow in a lot of capital and get market share. Otherwise, someone else will do it. And actually, the shoe idea came to me with Allbirds. I mean, this is a very interesting shoe company in the US that has become very, very popular very fast by growing very quickly because they make shoes made of sustainable materials and all of that kind of stuff. So it really, now that's the...
As long as you are reinvesting, that is fine, you are still creating value. For that you can raise capital. But to fund losses perpetually,
perpetually, I think that doesn't make sense.
After 10 years, you are running with most of the funded businesses are running with negative unit economics.
Correct. But I think that has to change. I mean, perpetually nobody can lose money, right? And this is consumer. Enterprise, we just funded a slightly growth stage analytics company that is profitable from day one, right? The math company. And they are profitable from day one. And, I think what would worry me is in businesses, let's say, for example, services businesses or math company, there if you are making losses, that would worry me. So in environments where you really shouldn't be making losses and you should have healthy economics, you must. In environments where you have to kind of sacrifice economics for the sake of growth, you just have to do it intelligently. I think that's the only answer at this point, right? Because I don't know the numbers of Oyo and all of those or Ola, but they are also running a race and they are continuously sucking capital. But I think there has been, at least with Ola, I know there has been a readjustment in terms of, okay, how are we going to become, ultimately a self-sustaining business going forward? You had.
So basically, as our statement says, like understanding P and VC. So the major part in India, at least startups that we speak to, who raise at least like at the Series A fund, they're a bit worried about like getting capital for the next levels because people started looking at venturing out onto the Singapore side and starting an entity there. So do you think this is required, or do you think there is capital in India who can fund? Because we don't have too many people. We have VCs and other people, but it's not a huge chunk. So people started looking at ventures also. Recently, I just saw news like fund raised 720K fund. Right? So when I started speaking to founders, so I just realized, talking to him, like he said, like he started a company in US. And Delaware, that's a normal norm now, and they started using a software-based company in India. That's how they started doing it. So, do you see that's a requirement going ahead for a company, or do you see there is a scope and there is enough capital in India who can, or people in India who can fund at higher levels?
This is a very popular question that comes to me and all VCs, right? That is there advantage in operating outside India? I think that that's kind of approaching it from the wrong end. It's more about where are your initial checks coming in. A lot of VCs or a lot of angels in India cannot write checks outside for foreign exchange issues. So if you have a company that's based in Singapore, based in Delaware, you're going to cut out a lot of these folks, including people like myself. So even family offices and stuff will not fund you. So then you better have people outside the country that can put money in, right? Similarly, if there are people outside the country that want to put money in but not in India, which happens, then you have to kind of play that, and you can say that, okay, I have more money coming from India and therefore I should incorporate in India.
No, it's not about the early stages. Like early stages, I understand like a check of 250K or something is like kind of, I don't say easy, but something you find people. So about that, it's not so easy to convince people, or you don't have many partners looking at these stages.
No, I understand. So when you look at growing, and again, flipping a company is not very easy, right? It's a lot of tax implications, it's time consuming, it's expensive. And I've had this discussion with a lot of my companies. I think that if you're, and I know examples, I mean, companies I'm in that I can't share right now, but there are India-based companies building global products that have lots of capital coming in. I think that if your business is exciting and it's valuable, then people will invest in it because no matter where it's incorporated. There are a few exceptions, it's not as easy, but because if, like AR/VR for example, if you are in a space that has appetite only outside India, and not big appetite, right? So for example, you're not talking about the large funds, but smaller funds that may not come into India because they're too small and they have no vision on India, then it might help to be incorporated there. So AR, VR, blockchain, there are two companies that come, two industries that come to mind, where you are disadvantaged by being here. But otherwise, generally, software services, SaaS, enterprise, all of that, consumer, I don't see it as an issue.
I had a follow-up question on that.
Yeah.
Like you mentioned, for technologies that are not ready for India at the moment. So, do you advise companies to incorporate outside, and how does their process from a VC?
So again, from his point was more not early stage; it was more later. I would go back to that answer and say that if you're clear that your technology has no ground in India and it is all going to be abroad, then I would not just incorporate, I would just pick up bags and move there somehow or the other. There is no point in incorporating optically outside. Either you're there or you're not there. And I want to address this dichotomy or this misconception that if we are a Singapore-based company, people will look at us as an international non-India company. That's all hogwash. When investors know that if you have a nominal thing in Singapore or Delaware and you have 100 people in India, you're an Indian company, right? So unless you really believe that you can pick up your bags, move there, hire in US, Singapore, wherever it is, then you truly become a global company. And I think focus on that rather than where the incorporation is. So that's not, that's not the way I would look at it.
And also the government is coming out with something called as POE, and point of effective management.
Yeah.
Which no matter where you have incorporated, if they find that the control and risks are managed in India, you will be treated as an Indian taxable entity.
Yeah, exactly.
And you have global taxes, not just Indian taxes. You need to watch out for all that when you're structuring your entity. POE, point of effective management. It's still doing the rounds in the parliament.
Yeah.
And so it's the Flipkart story, which is what got.
It's place of effective management.
Yeah.
POE. Yeah. So what happens is
That's one of the reasons why a lot of companies have started taking commercial heads. I've known 2 Indian startups doing the commercial heads in London, and they're trying to move to London. And exactly the reason is that the founder is a tech guy. He focuses more on the technology and the entire sort of business management, running the business, everything. So he's hiring a British guy in London to take over everything.
So,
obviously, I'm
just to
managing it.
kind of keep you all aware, the lawyers from that side will say it's all okay.
Yeah.
They'll say you just need to have a CFO or a finance director, controller, put these kind of effective heads, and so the UK government will be okay with it. They'll say, yeah, perfect. It's back home here.
Yeah.
And also, what happens is then you start looking at where your profits are being parked.
Yeah.
All of those issues will come out. And so you will have a perennial 25-30 year fight with one of the governments. And again, for all that structuring, you need to understand double tax avoidance treaties with the country and where you're servicing and stuff. It's not an easy thing.
Yeah, I always say that as an entrepreneur, you've got enough to deal with.
Yeah.
Don't overcomplicate your life. So it's important to keep it simple, right? I mean,
So Starbucks and Google paid their due to Europe after 20 years being in Ireland. So
yeah.
it'll come back to fight.
Yeah, Sanket, right? I want to understand from you, how do you look at this Ritesh Agarwal's 2 billion buyback in terms of, in wake, this is, quite different than, when we see promoter stake, going down, say, 10% or even less than that. and especially at this stage, she has bought back the stake. So how do you look at this? And
It's speculation, so I'd rather not say anything. I mean, I have my views on this, but I mean, I don't have anything that's that's from any kind of source or anything like that. But it is, in my view, a little bit around restructuring the cap table and to get the early stage investors out and so on and so forth. That it is unique, but it happens, I guess.
Before 5 years back, before I started my IoT institute, I am running my internet telephone business since 2000, and that's international B2B business. And it's a self proprietary business and have $100,000 revenue. So I'm going to and that delegate to my team. So I want to currently that team using my resources of fund and capital and relationship which we established. I wish that that business I want to that team should be also push up with the others back up. They have more capital, they can more business to with their telecom operator actually. So what is your advice if you think about that team to give a more power? Should I sell? What kind of sell? Example, this business which is a auto mode actually. Whether investors are looking for such kind of automobile business which is
No. We have no interest. Because at the end of the day, if you as the founder have kind of detached and doing something else, then the signal you're sending is that I don't think that business is as exciting as what I'm doing right now. So how will an investor believe that, right? That said, it's fine. It's auto mode. It's giving you some cash. That's okay. If you really want to grow it, then you have to bring a co-founder in that business, give them equity, and have them become the spokesperson and tell the story. Someone in the business has to take full control, accountability, and project excitement. Otherwise, on what basis will the investor come in, right? Yeah.
I just take 2 minutes to explain myself. I'm working for Indian Oil Corporation at this point of time. Almost completed 20 years of journey in this corporation. I have been toying with the idea of improvising healthcare services for quite some time. 2015, I had an idea and I came up with a technology with one of my friends, but I didn't quit my job. That's how it failed. I learned something from that, and now I am collaborating with 2 of my friends. Again, we are from middle class people, so far we have worked for a company for our living. So now it becomes very difficult to quit the job. And now we are ready, and I have reinforced myself, my thought process by attending all these conferences and everything, understanding this ecosystem. Now thing is that I have to start. Probably next month we are registering a company, and wherever I go, people look for the viral growth or the big ticket investments. So how to discover those angel investors, how to find them to fund us in maybe 50 lakhs.
The tie angels. Yeah. Yeah, I think it's great and all the best, and it is important in a team of professionals for at least 1 or 2 people to quit before you go out and raise money, because you can't have 3 people that say that we're still working at XYZ but we have this idea. At least 1 or 2 has to take the dive and go. But yeah, tie angels is the perfect platform.
Hello, my name is Anand and I'm CEO of SME Max. I wanted to ask you a question. How do you arrive at a valuation of a company that's not yet started earning revenues?
To your point, right? How do you figure the metrics and unit economics? I think it's more of an art, not a science. And for early stage businesses especially, we might look at 5-year plans and all, but everyone knows that's not practical because businesses can pivot very quickly. At least the best we can do actually is a 2-year plan, because even that sometimes within 6 months you're doing something else. So it's really about how much capital the investor is putting in, how much dilution the founding people want to take. So in early stages, if you do anywhere from 0 to 3 crores, typically you give up about 20% of the business. Of course, it all depends different from business to business. You may do that for 70 lakhs or for example, Ritesh with Venture Nursery gave up quite a bit for an early check of 70 lakhs, 1 crore. So it all depends, and it's less mathematical than one would suppose at that stage.
So you guys also invested in Ritesh, right?
But we got out, like my brother had sold before Lightspeed came. I think we sold 2 Lightspeed, so very long. But you can never do that, right? I think it's like Sanjay Mehta and all stayed and did well, but it's just you can never look back in hindsight because there's so many things that change the equation of what happens, right? So I think yeah.
So good morning, I'm Ulvish. I come from KNAB India. We're a group of investment bankers and business advisors. So my question to you is, like we usually associate venture capital with venture equity capital. Do you think this is the right time in the Indian market to pick for venture debt? Because I think that is something which balances both the sides of the equation, that there is portion is at risk and at the same time the dilution is taken care of.
So absolutely, I actually had a whole section on venture debt, which I didn't want to get into because it's not very long-winded. We're invested in venture debt funds also, to share openly, and I think that it is a good mode of capital for companies that have growth, and I'm coming back to you again to have this demonstrated some kind of unit economic balance and some stability. If you're not in that zone, you shouldn't be raising venture debt. I mean, you won't get it, and people that give it to you won't be very good because there are certain filters that a venture debt fund will apply for you to qualify for that.
Just to add,
Please.
So, even at early stages, there are funds that were giving debt now. And it's basically on your invoices. They're giving working capital also available, especially if you see that you have good invoices from your backed by good companies, then I think even that's happening.
So that I agree. Sorry, my answer to him was more if you're raising 10 crores of equity versus 10 crores of debt. Of course, what you are saying is right. I mean, that bill discounting and all can happen, but as a large round, I think it is important to be of a certain stage before you can get that venture debt.
So I'm curious.
I think even Caspian is doing that.
Yeah.
In the large ticket size.
Yeah. Correct.
So I'm curious, why would an early stage startup go towards the debt side?
Well, because you dilute less.
You dilute less.
On the other hand,
You're servicing that debt. Yes.
And you're valuing company implicitly.
So
it goes hand in hand with the equity investment.
Yeah, correct.
Basically, I get a time period where I can focus on growth and value myself more rather than diluting more. I mean, I feel like I know that next 6 months would be more beneficial for me.
I've seen that.
Also, if there is capex involved, so then I think to that extent they would go for that kind of.
You're selling us a short, that's what I'm saying. As an early stage startup, that's my view.
But I think, early stage, it's all kind of bespoke, right? But if your startup can service the debt and you can avoid dilution, I mean, a lot of people think that's a fair option. I mean, I don't.
For the venture, for the financing, so for the.
I think for both. And it's in this forum, it's difficult to dig deep into like specificities. But I think for both. I think it's a venture debt is a healthy kind of instrument that's there in the market. And of course, it applies in some cases, doesn't in some cases. It's not boilerplate in that sense.
Not debentures or convertibles, talking about debt.
Talking about debt, yeah.
It can be a convertible instrument also. It happens sometimes. It's basically a runway funding where the promoter believes that the business can grow, there is a great potential. He doesn't want to dilute his stake. So it's a very good instrument where there is a great potential.
Yeah, I have a slightly different question. More on the family office side. Say India is like growing in number of family offices now. What part? This is more to do with asset allocation. What part of the family's wealth, ideally, typically as a ballpark number, I mean, since the market goes into seed funding and VCs, we know a large chunk of it is usually parked because the idea is to preserve wealth and not lose wealth. So, from your experience or your peers, if you can.
I think this is a new asset class, right? Especially in the past few years. And to be very candid, when we started in 2011, I put money into our own funds because that's what we run. Only recently I've started becoming an LP in other funds, especially when there's no conflict with what I do. And it has become an asset class that has attracted money from the domestic market. So a lot of these funds didn't even have track record 5 years, 6 years ago. And now if you look at Inventus or Convergence Fund, Fireside that's coming out, or now A91 with the ex-Sequoia folks have come out. I mean, there's been established track record of the fund principals and what they have done, right? Or Kalari for that matter. And so there has been allocation from family offices going into this, as well as directly into companies. I don't know if I have a research number to be candid, but I would say it is still around sub 10%, because a family office will still typically be a lot in FD, tax-free, debt and equity. I think what I foresee in the next few years, because the equity markets over the past 5-10 years were amazing, right? They were tax efficient, they were growing well, but the next 5-10 years is not going to be as rosy. So I think a lot of capital might be directed more into these private investments over the next 5-10 years than it has been over the past 10 years. I don't know if that answers your question.
Thanks for the invitation. Which future businesses you are like to associate either India and US with your interest area?
So I think I love technology, and I really think that anything around deep learning, machine learning, AI, IoT, and applications of that within enterprise or consumer, although I prefer enterprise because that's kind of my DNA. I think all of that is exciting. The reason why I invested in a services business is also, I think services still has a lot of legs. It may not be that valuation model that VCs go after, but I think you can still build a great, credible services business and get people, maybe more private investors backing you. Yeah, I think those are the areas that I found exciting.
Hello, sir. This is.
And how are we on time? Keep going. Okay. I had a question.
Hello, sir. This is Tirumurugan. I'm working in State Bank of India right now. I was an expo founder. So my question is regarding about debt only. So recently, 100x.com, 100x.vc, Sanjay Mehta launched a fund like iSafe Loans, which is an alternative version of my company.
Okay.
So I personally feel that is one of the runway for funding process. Say for example, in the term sheet, whatever things you said, like there are the 6 weeks, 6 months.
Yeah.
But he is saying like within 3 to 10 days also we can fund that process for running the exchange terms. And the valuation is also that there is no such paper valuation. So he said like this is the first time he is going to do it in India. So how do you think about the iSafe notes kind of things coming up in India? So is it valuable to the entrepreneurs like in early-stage investors?
So I've done safe notes in the Bay Area. I think in the Indian context also it should work. But to be very honest, I don't know the details of what Sanjay, I read about it a little bit, I don't know the details of how he's implementing it. So that anyone else in the room can comment on. But safe notes have been done for a while now, and there is a way to quickly close, around. That's for sure.
There were some tax implications of that.
I don't know about India. I mean, the US there are no tax implications. I mean that is with India and angel funding and angel tax and all of that. There's so much going on that. I know the government announced in the budget also some, little bit of respite, but I don't know if that's come down to the actual administrative level. I still have lots of companies fighting with their tax assessment officers for these tax things. So fortunately, that's something I wish we could fix and fix really fast.
I'm Joykan from General Data. I've heard of tax benefits given to investors overseas, but are you aware of any tax benefits given to investors in startups here?
No.
No, not right.
There could be, I don't know.
No, you don't have. Just thought I'd check.
So are we?
Yeah, I think. Any other questions? Okay, so thanks a lot.
Thank you for having me. Thanks for committing.